So one of our favorite stocks in the Thornburg Investment Income Builder is CME Group. CME Group is the largest derivative exchange in the world. And it's a stock that's actually positively geared to higher volatility. So most stocks that we talk about are going to be negatively geared to higher volatility. CME is one that whenever volatility goes high and investors get concerned, they need to hedge some of that risk. So volatility increases. CME is a great business because they get paid for incremental volumes that fall pretty much to the bottom line. So as I look around the world
Ben, your prediction,
and look at some of the best business models,
you think we're moving into a world of much higher volatility, and the question is, for how long?
I think that's a fairly safe bet. Volatility has been muted for so many years. It could go on for several more years. Just the fact that we're late cycle, there's a lot of tug of war between the bulls and the bears, and recession probability and housing slowing. At the same time, a very strong economy. To me, that sets up an environment where volatility should just be a lot higher. CME can probably do $7 in earnings this year. They can probably do $9 in earnings by 2020. And that's a pretty interesting total return for a long-term shareholder.
Okay, you got another one on the list that I think is a little counterintuitive. Royal Dutch Shell. Why?
So oil is often a late cycle play. So we're actually fairly bullish on oil fundamentals, given some of the supply constraints we're seeing in Iran and Venezuela. Also some of the supply constraints coming out of the Permian. More than that, Shell is a special company because they generate a lot of free cash flow. So Shell has been able to maintain the dividend in the low oil price environment. Today, the dividend yield is high, and they're actually buying back $25 billion in shares. The last piece is that Shell is the world's largest LNG player. They have 20% market share in LNG. That's a great market, too. LNG demand is growing at more than 5% a year, and we think that prices for LNG continue to increase over the next few years. So Shell is a company that's trading at a low valuation. They have a lot of free cash flow. They're buying back shares. They have a big dividend. And although they're tied to the oil price, they have a lot of other good things going as well.
Hey, Ben, we got to go, but just two others on your list. China Mobile, you like? That feels a little risky to me. And then you like Electricity de France. Why?
I think China Mobile is a fairly safe stock. They have 36% of their market cap in net cash, and they have 80% profit share of the Chinese mobile market. So I think China Mobile is actually a fairly safe investment. Electricity de France is a very interesting investment. So the power price in France is about 50. The last time the power price in France was at 50, EDF, which is the nuclear generator in France, that generates about 70% of the power in the country. The last time the power price was at this level, EDF was at double the current price. So we think there is a possibility that the stock at 14 goes to 25 to 30 over the next couple of years.